Alex earns $50,000 a year, Jordan earns $100,000, Marcus earns $200,000. Same city, same cost of living, three different paychecks. By most assumptions, three completely different financial lives. But the difference between these three people isn't always where people expect it to be. Some things change dramatically as income doubles, others barely move at all. And the things that don't move are usually the ones that determine whether any of them actually builds wealth. Most people look at the income gap and stop there. The paycheck is just the starting number. What matters is what's left after the system takes its share, after the fixed costs land, and after the spending decisions pile up. Run those numbers honestly, and the picture gets significantly more complicated than a simple income comparison suggests. Let's keep this fair. Alex, Jordan, and Marcus are all 30 years old. Same city, same life stage, no inheritance, no trust fund, no side business generating extra cash. Each one earns a standard W-2 paycheck and pays federal income tax, FICA, and state taxes depending on where they live. We're not changing anything except the number at the top of the pay stub. One earns $50,000. One earns $100,000. One earns $200,000. That's the only variable. Everything else stays identical. We're not going to give Marcus a nicer personality or Alex worse habits. Just the income. That's the only lever we're pulling. First, what does the government actually let them keep? Alex earns $50,000. After the standard deduction of $14,600, his federal taxable income is about $35,400. His federal tax obligation totals approximately $4,000. FICA at 7.65% adds another $3,825. Before any state taxes, Alex is clearing around $42,175 a year. That's about $3,515 a month, not $50,000. $42,000. The number on his offer letter and the number he actually deposits are already different before he makes a single decision about how to spend it. That gap matters. It matters enormously. Jordan earns $100,000. After the standard deduction, taxable income is roughly $85,400. Federal tax lands around $15,000. FICA adds another $7,650. Take home before state taxes is about $77,350, around $6,445 a month. Jordan earns exactly twice what Alex earns, but Jordan's take home is about $2,930 a month more than Alex's. Not double, not even close to double. The tax system starts compressing the income gap before either of them spends a dollar. Every time someone says they'd be fine if they just made twice as much, this is the part they're not accounting for. Twice the income does not mean twice the take-home. That's not how the brackets work. Marcus earns $200,000. After the standard deduction, taxable income is roughly $185,400. Federal tax comes out to about $42,000. FICA only applies to the first $160,200 in wages, so his FICA bill is capped at around $12,255. Take home before state taxes is roughly $145,745, about $12,145 a month. Marcus earns 4 times what Alex earns. His take-home is about 3.5 times Alex's. Still a massive gap. But the IRS has already carved a meaningful piece out of that advantage before Marcus sees a single dollar deposited. The 4-to-1 income ratio becomes a 3.5-to-1 take-home ratio almost automatically. Here's the first thing almost nobody acknowledges. The cost of basic survival doesn't scale with income. Rent, groceries, utilities, transportation, health insurance. These numbers are roughly fixed regardless of what you earn. A one-bedroom apartment in a mid-tier American city runs about $1,400 to $1,800 a month, whether you pull in $50,000 or $200,000. Groceries run $400 to $600 a month for a single person. A basic car payment with insurance runs another $600 to $900. These aren't luxury choices. They're basic baseline costs, and all three of them pay roughly the same baseline. Call it $3,000 to $3,200 a month to cover housing, food, a car, and basic insurance. That number is the same for all three of them, at least before lifestyle inflation enters the picture. For Alex, $3,000 in fixed monthly expenses consumes about 85% of his take-home pay. That's not a budget, that's a math problem. After covering the basics, he has maybe $500 left each month. There's no real room for saving, no cushion. A single unexpected expense, a medical bill, a car repair, a broken appliance doesn't just disrupt the month, it potentially wipes out weeks of surplus. He's not being careless with money. The numbers just don't cooperate. At $50,000, discipline alone doesn't close a $500 a month savings gap. The income itself is the binding constraint, and pretending otherwise doesn't help him. Jordan's $3,000 in fixed expenses eats about 47% of his take-home. He has over $3,400 a month left after covering the basics. That's where $100,000 starts to feel genuinely different from $50,000. Not in the paycheck, in the margin. Jordan can max a Roth IRA at $7,000 a year without disrupting his month. He can push 15% into his 401k and still have cash left over. He can build an emergency fund over 6 to 8 months without sacrificing everything else. The $100,000 income isn't twice as financially powerful as $50,000. Measured by what's actually available to build wealth after taxes and fixed costs, it's closer to 5 or 6 times as powerful. That's the number people should be focused on, not the gross salary, the investable margin. Marcus's $3,000 in fixed expenses eats about 25% of his take-home. He has roughly $9,100 a month after covering the essentials. On paper, Marcus should be stacking serious wealth every single year. Should be. Here's the problem. His expenses don't feel like expenses. At $200,000, almost every individual spending decision feels manageable. That feeling is the exact mechanism by which high income stops translating into high net worth. The absence of financial pressure is itself a kind of financial risk. Nobody panics Marcus into reviewing his budget. Nobody ever tells him his situation is urgent. It just quietly stays the same. This is the part most income comparison articles skip entirely. Lifestyle inflation isn't reckless spending. It's 1,000 small upgrades that each feel completely reasonable at a given income level. A nicer apartment, maybe $700 more a month. A newer car, maybe $400 more a month. More restaurants, better vacations, a home gym, premium subscriptions, upgraded everything. None of it triggers an alarm because none of it is individually alarming. Added up, Marcus could absorb $4,000 to $5,000 a month in lifestyle upgrades without noticing them hit, and then he'd have roughly the same $4,000 a month available to invest that Jordan has. Same margin, 4 times the income. That scenario isn't unusual. It's the default outcome for most high earners who don't deliberately manage it. Now let's look at taxes more carefully, because at $200,000, Marcus runs into things Alex and Jordan never have to think about. Both Alex and Jordan stay inside straightforward federal brackets. Marcus doesn't. Above $200,000, the net investment income tax adds 3.8% on top of capital gains from investments. The additional Medicare surtax of 0.9% kicks in above $200,000 for single filers. IRMA surcharges on Medicare Part B and Part D premiums begin phasing in based on income reported 2 years prior, a detail that catches almost everyone off guard the first time they hit it. These aren't theoretical risks. They're automatic line items that show up regardless of planning. Most people earning $200,000 don't encounter them until the bill arrives. That's not a tax strategy, that's a surprise invoice. Here's what actually separates these three over a full career. It isn't the income number. It's the savings rate. Alex saving 10% of his take-home puts away about $4,200 a year. Jordan saving 10% puts away about $7,700. Marcus saving 10% puts away about $14,500. Same rate. Substantially different dollar amounts going to work each year, but flip it. Jordan, saving 25% of his take-home, puts away about $19,300 annually. Marcus, saving 10%, puts away $14,500. The lower earner, with the higher savings rate, invests more money every single year. Same time horizon, same market returns. The lower earner ends up ahead. The income creates the opportunity. The savings rate determines whether the opportunity gets used. Run the investment math over 30 years at 7% average annual growth. Alex, saving $4,200 a year, retires with roughly $425,000. That's a retirement with a serious problem attached to it. Jordan, saving $19,300 a year, retires with about $1.95 million. Marcus, saving only 10% or $14,500 a year, retires with about $1.46 million. Jordan earns half of what Marcus earns. Jordan retires with more. This isn't a hypothetical edge case constructed to make a point. It's what happens when savings rate beats income over a long enough time horizon. The math is indifferent to who earns more. It responds to what actually gets invested. This is the core principle. Everything else is commentary on top of it. What doesn't change at any income level is the drag of high-interest debt. Alex, carrying $8,000 on a credit card at 24% interest, is losing about $1,920 a year. Jordan, doing the exact same thing, loses $1,920 a year. Marcus, doing it, loses $1,920 a year. The rate is identical. The debt doesn't negotiate with higher earners. It doesn't offer a discount because the balance looks small relative to the paycheck. At every income level, the people who carry expensive consumer debt into their late 30s are running a slow, permanent leak in the foundation of their financial plan. That leak runs at the same rate regardless of the income. It just feels more tolerable to Marcus, which is exactly why Marcus is the most likely of the three to let it linger. Emergency funds operate the same way. The 3 to 6 month rule doesn't bend for income. Alex needs about $18,000 to cover 6 months of essential expenses. Jordan needs roughly the same. Marcus, assuming he keeps his fixed costs reasonable, needs roughly the same. None of them gets a pass on this. The fund has to exist before aggressive investing fully makes sense. Alex has the hardest time building it. That's real. But even Marcus, with $9,000 a month in surplus, frequently skips building a real emergency reserve because at his income level it never feels urgent. And then something happens, a job loss, a health issue, a major home repair, and suddenly someone earning $200,000 is liquidating a brokerage account and paying capital gains taxes to cover a gap that a $20,000 savings account would have handled quietly and without consequence. At $50,000, the financial priority is straightforward. Cover the essentials, eliminate any high-cost debt as fast as possible, and save whatever small amount is possible consistently. The income is the real constraint. At $100,000, the priority shifts. The margin finally exists. The window is open. The job is to lock in a savings rate before lifestyle inflation closes it permanently, because the window does close. It closes one reasonable upgrade at a time until someone earning $100,000 feels exactly as financially squeezed as they did at $65,000. At $200,000, the priority becomes strategy. Tax optimization, account sequencing, managing exposure to IRMAA and investment surtaxes in retirement, structuring withdrawals to control bracket placement decades from now. Not because the basics stop mattering. They never stop mattering. But at $200,000, the basics are covered. The game has changed. The question is whether Marcus has noticed that it changed, or whether he's still just watching the paycheck land and assuming the rest works out on its own.